Hello, this is Andy here talking with Adrian Day from Adrian Day Asset Management. How are you, Adrian?
Well, I'm fine, thank you. And thank you for asking me, Andy.
Great. Before we get going, I have a really fun story. It was, I want to say 1994, and you were a keynote speaker at a conference, and I was just a very young lad, probably your age. And you were one of the keynotes. This actually makes my day talking to you. So thank you very
Wonderful.
much for coming.
1994. Where was that? Do you remember?
I believe, if I'm not mistaken, I want to say it was at the New Orleans
Oh,
Investment
okay.
Conference.
Okay.
Jim
Yeah.
Blanchard, the late Jim
Yeah. I go
Blanchard.
there every year. Yeah.
Yeah, and you were a headliner there. So this makes my day talking with you.
Well, thank you.
You're very welcome. So tell me, we've had a lot of activity in the first part of the year, if you would, with the gold and silver or the precious metal markets. And then probably the last 60 days or so, we've had some sideways movement, which is to be expected, if you would. And then we're coming into some seasonal, typically strong seasonal times. But just give me what you think is going to happen the second half of 2023 in precious metals, as well as, and also the precious metals equities.
Okay. Well, look, first of all, let's just look at gold itself before we look at the equities. And I won't spend a lot of time on this, but just there's obviously an awful lot of different factors that can and do affect gold, from inflation to geopolitical to interest rates. All sorts of things can affect gold. But I think markets are forward looking, and we sometimes tend to forget that. We look at what's happened or what's happening now, but markets are forward looking. And to me, the most important factor affecting gold is not what inflation is doing. It's not what interest rates are doing. It's whether, when the market thinks that the Federal Reserve is going to pause or stop before they have conquered inflation, without conquering inflation, then gold does well. So at the beginning of this year, you mentioned gold was up. We had a lot of talk about the pivot and everything else. I always thought, to be honest with you, I thought it was overly optimistic. But if you looked at the Fed funds futures, they were calling for 2 or 3 rate cuts. They were looking at an average of 75 basis points, so 2 or 3 rate cuts before the end of the year, which I thought was optimistic. Anyway, go forward a little bit, and even though Powell paused or skipped in that famous slip he made, the talk was tough, and so the market thought, with the dot plot and everything else, the market thought we were going to have more rate hikes. So it's a matter of whether the market thinks the Fed will stop before we've conquered inflation. In my mind, there's little doubt that that is going to happen, but I'm not as dovish or optimistic or whatever you want to call it as a lot of my friends. We're obviously going to have a rate hike next week. That's sort of baked in the cake. I think we're going to see another one or maybe even 2 before the end of the year. Depends what the dot plot says, and of course August there's no meeting, so that's an automatic skip, which is, I think the Fed is very thankful for that. But anyway, to the bottom line is, I think we're getting a bit of a respite in inflation numbers right now, which I think is fooling people into thinking that inflation is coming down dramatically. 2 things quickly. The core, obviously, which the Fed focuses on, is still quite strong. It's come down, but a 4.7 on the PCE, which is what the Fed looks at, that's really still very strong. And secondly, look at what's happened in the last month. The oil prices started to move up. Well, in 1 to 2 months, 6 to 8 weeks, that all starts to feed through. Energy, of course, is out of the core, but it still feeds through to things like transportation. It feeds through, of course, to everything we buy in the stores, but it has to be shipped. So that's one factor. And the other factor, the other thing is agricultural commodities have started to pick up after a weak first half. So, I suspect that we'll get another month or 2 of lower inflation numbers before, by the end of the year, they start to pick up again. So anyway, the bottom line is, I think next year, I think we'll definitely see the peak in Fed funds rate this year, whatever it is, but it'll be this year. Next year, they might hold it steady for a while. Then the economy starts to fall into a recession, obviously fall into a recession. I think we're sort of heading there very rapidly. But inflation numbers will still be stubborn. That was a long-winded answer, I'm sorry, but I think you get it. So in other words, if that's the scenario, then gold is going to do very well in the last 3-4 months of the year.
Got it. So what you're saying is, and again, this is somewhat repetitive, is that you still expect a hawkish Fed, if you would, if not raising rates, but that gold would be rallying into that because in 24, the Fed will more than likely be done because inflation will, the perception of inflation, if you would, will be coming down. And that will give in 24, and that will give gold the cause to rally because, again, markets are forward thinking.
Yes, absolutely. And we saw that, we've seen that in the last couple of years. People have been surprised that, in 2022, when you saw inflation numbers move up, in March, April, May, gold was falling. What's going on? Then at the end of the year, the inflation rate started falling from October, November, December, and gold started moving up. It's because gold is not looking at what's happening now, nor what's happened in the past. It's looking at what they think is going to happen. Okay.
So you manage money, and you specifically, you have a bent, if you would, or a worldview of with precious metals should be in that. So you're thinking gold will rally, and I would agree with you in the second half of the year. How does the average investor construct a portfolio to not only protect themselves, but to take advantage of that coming tailwind?
Well, the most important advice I could give to anyone whose money we are not managing is to give us a call. But apart from but after that, the gold sector, we'll look at a whole portfolio in a minute, but the gold sector is one of the most idiosyncratic out. And by that, I mean, you can have gold up $50, $100, $200, and you can have half of your gold stocks down. And it's always been like that. And there's reasons for that we don't need to go into, but biotech is like that as well. They're just idiosyncratic. Now, I've done a study, I've done several studies at different times. I haven't done it for the last year, to be honest, but I've done it a half a dozen times in the past 12 years, where I just look at the first 6 names in the XAU, or I look at the bottom 6 names alphabetically. I pick them at random, and I look at 1 year, and it's remarkable. The last time I did this study, the number 3 stocks were up, 1 was flat, and 2 were down.
Wow.
1 was up over 100%, 1 was down over 30%. And that's in the same gold market. So stock selection becomes very, very important. Now, some people think, well, the way to solve that is to buy an index. Now, there's no question that if gold goes to 2,500 or 3,000 and you own a GDX, there's no question you'll be happy.
Right.
But the problem with the index is that you're buying the good, the bad, and the ugly. There's a lot of bad and there's a lot of ugly in the gold space. So I prefer to buy, and I'll give you names, I prefer that what we'll call an ordinary, everyday retail investor who's not going to spend all day long, following this, calling companies, going on trips. I would recommend they stick with what I call the biggest and the best. So companies like Agnico Eagle, which is the 3rd largest gold mining company in the world, with a super strong balance sheet in solid jurisdictions like Canada, Australia, Finland, plus Mexico. Franco-Nevada, which is the best of the royalty companies. Wheaton, I would stick with 4 or 5 companies like that. If you buy, 5 companies, and basically hold them. You can trim them when on big rallies. I think the biggest mistake a lot of people make is to sell their gold stocks too soon. Don't forget that if gold goes to 2,500, these stocks don't go up 10 or 20%. They double and triple, even the big ones.
Right.
And you don't want to miss out on that, spoil the ship for a penny worth of tar, as we say in England. So stick with half a dozen, Agnico, Barrick, Franco, Wheaton, maybe B2 Gold or maybe a Cisco, something like that.
Right.
And you'll do well.
Got it. Where do the mid levels and the juniors come in, or do they, and producers as well as exploration companies in your mind?
Yeah, well, we own a lot of the entire sector across the whole spectrum. We own a lot of second tier companies, either because they're good in their own right, like B2 Gold, which has like 4 different mines, super strong balance sheet, pays a good dividend. I think it's over 4% right now. But also because those are the companies that are most likely to be takeover candidates. So we like that sector. We own a lot of exploration stocks, but I tell you, if you're going to invest in exploration stocks, you either have to follow them yourself very, very carefully and understand and know the sector, or I have no objection. People don't like it when I say this sometimes, or find someone you like and follow him. Joe Mazumdar has a great newsletter for junior explorations, exploration insights. Buy it, it's expensive, buy it and follow what Joe says. For example, that's an example. The most important thing is, if you're going to follow someone, please don't just follow them when they say buy and don't follow them when they say sell. And I've seen that too many times. So with the juniors, I love the juniors, and another thing that in smaller investors or investors who aren't going to spend all day on this can do is look for companies where they have a business plan that mitigates the necessity to keep going back to market, because that's what kills exploration companies, the dilution. I can name companies where they've done a good job, they've had a discovery, but the share count has gone from 10 million to 250 million. How are you going to make money with that kind of dilution?
You're not.
So stick with companies that have a business model that mitigates that. A company like Origin, for example, which has royalties. They explore, they generate prospects, they sometimes stake them, they sometimes buy them, and then they farm them out. Other people spend the money exploring, and they keep royalties. So they have a royalty on Ermitaño in Mexico, First Majestic's mine, which brings in cash flow. So their overhead is covered by their cash flow, and then they can generate these prospects, which give them the big upside. But they don't have to keep going back to market. It's that kind of company I like. And there's a few I could name if you want me to.
Please do. Yeah, go ahead. Please do.
Well, another one would be Midland, for example, MD. It has about, oh my gosh, it's probably got about 13, 14 active joint ventures. It does the prospect generator model. So it generates prospects and does farm outs, earnings with other companies. Sometimes they're joint ventures where Midland spends 30%. Sometimes they're just options and the other company spends all of the money. But they've got about 13 active joint ventures, all in Quebec, which is a great mining jurisdiction. They've got a good balance sheet. They don't have to keep raising large amounts of money, a good technical team. And their partners include, Rio Tinto, BHP, Agnico Eagle, Barrick, Cisco, Soquim. I mean, who else? You couldn't ask for better partners.
Right.
Now, the problem with the big companies like Rio and BHP is they want to be very, very methodical. They spend a lot of time, and they might spend 2 or 3 years just doing geophysical and surveys and mapping. And sometimes investors get impatient. Hey, why don't you drill the thing? Well, big companies don't just go in and drill. Big companies take the time to understand the project and then to understand where the best targets for drilling are.
Yeah.
So companies like that, yeah. And there's several like that.
Got it. So I guess to summarize, would you do like a top down, like if, again, the average Joe on the street, would you do like a top down portfolio where they were start with the big names that you mentioned then go over to maybe some smaller producers and then the exploration companies.
Yeah, that's right. I mean, first of all, the big miners like Agnico, Barrick, Newmont, even I prefer the other two over Newmont, but those are the most certain to move when gold moves. They're also the first to move when gold moves. So that should be, that should be where you start. The big royalty companies, Franco, Wheaton, Royal, that should be a foundation because they are super low risk. They might be a little expensive, but they're super low risk. Even if gold drops, they'll drop less than mining companies and then start going down. Yeah.
Okay. Is there any place in the world, because a lot of these companies are global, if you would, that you would just stay away from?
Yeah. Actually, I'm different from a lot of my friends on this, like Rick Roll and, well, even the Lundin family. You know them, famous mining company, and they almost seem to relish in political risk because they say that's where you get the better projects at the cheaper price.
Right.
My own view, my own philosophy or approach to this, if you like, is that in mining, we are taking enough risk anyway. We're taking, a price risk, we're taking geologic risk and all sorts of metallurgical risk. We're taking enough risk anyway that I prefer safer jurisdictions. So that's just one more risk I don't have to deal with. So I mentioned Agnico, which is in, two strong areas in Canada, plus Australia, Finland, Finland's a great mining jurisdiction, by the way, if people don't know it, because it's not so big in gold, but people, if you don't know it, that's a great mining jurisdiction. And then also Mexico, which has slipped in the rankings a little bit. But that's a very, very strong political risk profile for a company. Barrick is another one I like. Barrick likes to take political risk, and Mark Bristow, the CEO, is very good at dealing with political risk, which is another issue you have to look at. Can the CEO deal with political risk? But there in Pakistan, Congo, Saudi Arabia, Egypt, think of other than North Korea and Cuba, I think you name the worst countries in the world and they're there.
Right.
But I like to say at least they've diversified their political risk, so we don't have to deal with problems all at the same time. But if you're looking at a single asset company, I would stick with one that's in a good jurisdiction.
Got it. Okay. Lastly, in closing, from a gentleman that's been through a lot of battles and has a lot of battle scars, what's the best piece of advice you can give somebody as they start this journey?
I love the way everybody uses euphemisms to say you're old.
Hey, I'm not too far behind you. So
I was once on a panel and they asked all these young kids, what's your best pick? What's your best pick? Well, Adrian, why don't you give us some words of wisdom? Best piece of advice, my gosh. One is to be disciplined in buying, disciplined in following, disciplined in selling, and to be patient. It takes a long time for these things to play. If you're looking at an exploration story, for example, it takes a long time for these things to play out.
5 to 10 years, right?
Disciplined. Yeah, easily. You have to be disciplined and you have to be patient.
Got it. Okay. Well, Adrian, I want to thank you so much for your time. I'll put in all of your contact info in the show notes, but please tell us yourself where people can find you and reach out to you.
Yeah, well, our website is Adrian Day Asset Management.com, and we've got lots of videos on there, interviews. There's also a Q&A, a chat box, whatever you call it, where you can, answer a question and get an answer, so more or less immediately.
Got it, directly to your website. Well, I want to thank you so much for your time and a great memory from about 30 years ago.
Well, thank you very much. I appreciate it.